Welcome to The Beehive, the podcast where we explore the latest trends, challenges, and strategies in the world of finance and corporate governance. I'm your host, William, and today we're kicking off a new series of episodes about the intricate world of technical accounting. Today's episode is all about stock-based compensation. We'll dive into the current trends and explore some of the hot topics shaping the future of SBC. Joining me are JM and Rain. Glad to have you guys. First, we have Rain, a technical accounting manager at Scrub. He specializes in stock-based compensation and brings knowledge of the intricacies of equity compensation and its impact on financial reporting.
Thanks for having me here. I'm excited to discuss stock-based compensation and looking forward to sharing some insights and answering any questions that you might have.
Great to have you, Rain. We also have JM, a technical accounting senior manager with years of experience assisting clients in figuring out stock-based compensation programs. He is also Scrub's ESG knowledge lead. Today, he'll provide insights on how SBC programs and ESG align.
Yeah, happy to be here, Will. Looking forward to sharing my insights in terms of the collaboration between ESG and the share-based compensation programs.
Again, great to have you guys. Together, Rain and JM will offer valuable insights into the evolving landscape of accounting and compensation. So let's dive in. Have you ever wondered why some companies offer stock options as part of their compensation while others stick to traditional salaries? What if I told you that these choices have deeper implications for a company's growth and your personal wealth? Today, we'll explore how companies use stock-based compensation programs to align executive goals with shareholder interests and drive long-term success. We'll also discuss how these strategies evolve and what that means for you. Let's kick things off by discussing updates about the SBC landscape. Rain, I think this seems like a good place to start, right?
Certainly will. After the pandemic, the global economy went through some big shifts. So we witnessed the great resignation, a rise in special purpose acquisition companies, more company acquisitions, and a surge in startups. During this period, many companies started offering stock-based compensation and reevaluating their share-based compensation plans due to new regulations. However, as the company continues to evolve, companies are rethinking their stock-based compensation strategies. They're asking if their current stock-based compensation plans still make sense or if they need changes. New regulations are also pushing companies to ensure their executive pay aligns with company performance. This means that they need to tie compensation to specific performance goals, be transparent about it, and carefully manage tax implications.
Wow, the great resignation, right? I think that was the big quit.
Even before, but definitely during the pandemic, great shifts started to happen, particularly when employees were very visible in terms of the various opportunities, particularly working remotely, which we'll also cover later.
Yeah. Do you remember what you guys were doing back then? Especially dealing with U.S. clients. Is there any, big changes in your guys' workflow during the Great Resignation?
Yeah, there were a lot of changes, particularly accountancy and other professionals are not yet very familiar with terms of the working arrangements, particularly when you're working from home. A lot of people are adopting. But then again, the adoption is not just in terms of adopting is not limited to the employees themselves. Companies are also struggling in terms of adapting to that change and now offering different considerations for that. And a lot of regulations are coming up dealing with that. And remote work has still been a topic of interest for years, months, and even weeks. There are a lot of releases or discussions concerning remote work arrangements, which I'll cover in detail later on.
Yeah, so economic trends or economic changes. How might these changes impact companies' financial strategies, actually?
When companies adjust their stock-based compensation plans, it actually affects their financial statements. For example, if a company shifts from offering stock options to providing cash rewards, this could change how they record and report these expenses. Minor changes, though, may not affect financial reporting much, but significant ones will. It's also very important for companies to consult with financial experts when making these changes or these adjustments And technical accountants or financial advisors, of course, can help ensure that these changes are handled correctly and that their financial reports remain accurate and, of course, compliant with regulations.
Yeah, speaking of changes, JM, from traditional ways or reasons in SBC issuances, are there changes in how SBCs are utilized now?
Yeah, definitely will. Share-based compensation programs are used to attract, retain, and motivate employees, investors, professionals, and other stakeholders that the company has dealings on. Basically, to strategically align stakeholder interests to the company's long-term plans and strategies. Historically, share-based compensation programs are only open to executive and senior management employees, but now, due to the shift into the needs of the business, several companies are using share-based compensation programs to actually improve non-executive employee engagement and retention.
Yeah.
And to clarify that further, by offering those options or compensation or incentives to non-executive employees, they are now motivated to ensure the company's long-term success, basically aligning their mindset to the mindset of senior management. So basically, incentivizing people to help the senior management in terms of ensuring the company's long-term success.
So it's a win-win for everyone.
Yes, definitely. And further, having various vesting conditions such as performance-based metrics, KPIs, or setting longer-term vesting periods, share-based compensation programs often encourage improved performance and retention within the company itself.
So would you say that in a competitive market, for example, when companies are hiring, do companies who offer SBC programs, do they have more applications, would you say, rather than companies who prefer the traditional way of just salaries?
Yeah, compensation programs have opened their field in terms of the various changes or opportunities to tailor their employee compensation. Meaning, instead of the traditional regular pay or salary, they're open now in terms of properly tailoring the performance that they require for an employee to the incentive that they will get. Certain examples would include, I'll cover more on the discussion later, but I'll give an example to kickstart the conversation is some metrics would include attainment of certain goals, say this much of revenue, this much of profit. Previously, those are tied to executive level. But now, say you're giving share-based compensation to key leaders, not yet senior managers, but key leaders within your operations, your marketing, or your sales team. You now give them certain metrics that will definitely tie into their pay, to their share-based compensation, not just to the traditional salary.
Oh, that makes sense. All right. Now, JM, putting your ESG knowledge into the SBC space, what linkages do you see within these spaces? Can you share some thoughts on how companies are integrating ESG factors into their SBC programs?
Yeah, definitely. We're looking forward to discussing this because as ESG continues to be like a topic of interest for regulators, now ESG-linked based or ESG-linked share-based compensation programs are becoming more prevalent for companies to recognize the importance of sustainability and ethical practices in the business. And of course, they want to ensure, since there are various regulations coming up, they want to ensure share-based or that their sustainable goals are in line with the regulation. So they tailor their share-based compensation programs to meet those requirements.
Can you elaborate further what you mean when you say ESG linkage SBC programs?
Yeah, so on our discussion earlier, I've discussed in terms of how share-based compensation programs are linked into the traditional KPIs like profitability, revenue growth, customer base growth as the traditional metrics. But now KPIs for ESG-linked share-based compensation programs would include carbon emission reductions, resource planning, say they are using this type of mineral, but since this is a scarce resource, they need now to manage or finding alternatives in terms of still developing their products, but they're able to transition to a more renewable source than the initial non-renewable source that they're using to build their products. And of course, other environmental considerations.
Yeah, so that sounds like a step in the right direction, but it also sounds like there are challenges involved with this. For instance, how do we measure and reward ESG performance?
Yeah, so on top of the environmental metrics, there are other social and governance metrics that are also being considered. For example, I'll give some level examples in terms of the companies implementing share-based compensation programs that are ESG linked to like further clarify on how it is being implemented. Say Alphabet or Google, as we know them, has initially tied their executive compensation to progress on climate change goals such as reducing greenhouse gas emissions and their investments into renewable energy. Similarly, Microsoft has also established their Climate Innovation Fund and links their, again, executive compensation to achievements in their climate-related initiatives. Now, to further answer your question, those factors that I've discussed are not traditional. It's harder to measure them right now, given the knowledge that the current economy has, the current knowledge that we have in terms of measuring this. They are still considered as intangible factors like social impact. How do you measure happiness of your community? How do you measure the happiness of your other stakeholders? How do you say that they're interested with your growth? They are in agreement with your performance and your growth and other factors that you still have to consider. So this complexity requires that companies establish certain metrics and consider following reporting frameworks to standardize their reporting. Basically, companies need to develop clear and objective ESG metrics to incorporate them into their share-based programs effectively. But to give certain examples, best practices in the industry would include using industry standard frameworks like the Global Reporting Initiative, the GRI, Sustainability Accountant Standards Board, the frameworks that they've released, and some other frameworks like the Task Force on Climate-Related Financial Disclosures, that's TCFD. We also have TNFD, or the Task Force on Nature-Related Financial Disclosures. So those guidance would help companies to set objective ESG goals and metrics to properly measure their performance. But why is that important? Now, ensuring objectivity is very crucial, particularly in the field of ESG, because we definitely want to avoid greenwashing. So greenwashing is basically saying that you have this step towards your environmental goals, but in reality, you did also step back on some other initiatives that you've launched. So to help this out, companies should seek help from third-party ratings or getting certifications or getting audits, verification, and ensuring that the professionals who handle the accounting of the ESG metrics or their performance are also trained and well-seasoned professional in the field to help them verify that their ESG performance are credible and accurate.
Companies are increasingly focusing on these pay equity and on improving diversity through their stock-based compensation programs. But one challenge in dealing with this pay equity and diversity is actually the unconscious biases on compensation practices. So to address this, companies should be transparent about their pay policies, and they should regularly review their processes. And then also, just to share the best practices that we have for promoting pay equity and diversity, we can actually conduct regular pay audits so that we can identify any gaps, and of course, we can investigate in their causes. And then we can also implement transparent compensation policies, and we can provide diversity and inclusion training that can also help address these unconscious biases.
Would you say that pay equity is still a prevalent issue in today's world as compared to maybe 20 years ago, 30 years ago?
I think yes, some companies or even countries are actually not paying all of their employees fairly, but not really consciously. It means that some companies or some employers are actually unconscious about this. That is why, to address this, maybe they have to or they need to provide trainings about diversity and inclusions. They can have audits of their pay equity so that we can make sure that these unconscious biases on compensation policies are addressed.
Yeah, so aside from that, it sounds like transparency is the key here, as you've said. So companies can build trust and ensure fairness by, addressing unconscious biases and clearly communicating compensation criteria. Now, let's talk about the remote work and global mobility. This topic has been gaining a lot of traction lately.
Yeah, definitely. Well, as I mentioned earlier, remote work discussion hasn't stopped.
Mm.
There are a lot of talks in the past few weeks, months. Certain trends in the social media space has been gaining a lot of traction, particularly when it comes to questioning how should remote work should be established properly. Now, I'd like to add in another complexity on that space.
Okay.
So, factoring share-based compensation programs for remote work employees. Earlier, we discussed why share-based compensation programs are important to trickle the impact or the incentives down to the employees, aside from senior management, right?
Mm-hmm.
So, we're giving these incentives to employees, but now we also have to factor in certain complexities within that space because of remote work arrangements.
Give me an
So-
example of those complexities.
Yeah. So, for example, an employee is we like to work during travels, right?
Mm-hmm.
There are a lot of digital nomads,
Yeah.
or they're working in different countries. When you work in different countries, different states for that matter, you're now under different tax regimes.
Oh.
So if you're getting share-based compensation, there are certain benefits given by certain countries in terms of like tax incentives for share-based compensation. Now, those tax incentives might not already be applicable if you move or work into another country or another area or another state for a longer period of time than what is expected from you. So this raises complexities and some other legal regulations. So definitely remote work and global mobility requires companies to adopt their share-based compensation plans to address those tax implications and regulatory compliance with different jurisdictions. So determining the appropriate tax jurisdiction and proper legal or regulatory requirements that is applicable to your employees is a matter of complexity that has to be consulted with professional tax advisors and other advisors who can properly help the company figure out and properly tailor a plan or policy to ensure that while giving our employees freedom to navigate the globe, I would say, or move from one location to another, certain controls must be in place and policies must be in place just to ensure that they still get the tax incentives that they should get or they are taxed properly and within the regulatory requirements of the law. And to do that, technology has ever been evolving. So I would suggest the company to revisit the current technology systems that they have to help them figure out how to cascade the necessary information and triggers to the employees so they'd be aware of any violation or tax concerns. Say they'll be missing out on incentives if they work longer period outside of their usual residence. So those information are necessarily to give our employees proper information and keep them informed on the potential consequences of their transition from one workplace to another. So, but again, share-based compensation and remote work are good incentives for employees, but definitely has to be considered altogether.
Yeah, so I've heard that some other companies just, in regards to control, they just kind of pushed it to the next level, wherein they disallow their employees to actually be a digital nomad. So when they say work from home, they gotta do it from home, right? So would you say that that removes the complexities of the example that you've said in regards to tax for moving it to different regions? Would that be a better solution rather than figuring out SBC? What do you call this?
Figure out the SBC or the applicable tax rates or the complexities. Definitely will. That could be a solution. But I would say a proper balance between share-based compensation, remote work, and the employee well-being in once, and also putting balance in terms of legal compliance is important. So balancing those aspects would definitely bring in better employee engagement and retention. Again, we just have to make the employees aware of the decisions or the impact of the decisions they would want. Say they want to still work beyond the normal or the allowed working days to a certain location. They just have to be open in terms of the additional tax that they might pay on terms of their compensation. So this is not just applicable for share-based compensation, but all other forms of compensation.
So it's a balance between giving and receiving from both parties.
Definitely.
Because they still want to... I'm surprised that... or I'm happy that companies are thinking about the the well-being of their employees or the happiness. That's a big consideration for them. Now, I want to just circle back on the SBC programs or the program metrics, particularly performance-based compensation. What's the latest on tying SBC awards to performance metrics?
Well, actually, Will, before I answer your question,
Yeah.
I want to answer first, or I want to clarify first why companies are offering stock-based compensation. Maybe because you are thinking, or you might be wondering, why these companies are offering these employees stock-based compensation even though they are already paying salary or these
Yeah.
employees salaries. So is this stock-based compensation, isn't it, it's just an additional cost for the company, so why do they do it? So the main reason here is because, well, it's also a win for the company. There is also also a benefit for the company, not just for retaining employees, but actually stock-based compensations are mostly measured based on the fair value of the stocks of the company. So how can these companies have higher fair value of stocks? That is when, of course, their performance is good. That is when they have higher net income. So how can they have this higher net income? They can have, or they can obtain these high income by, of course, motivating employees
Yeah.
and ensuring that employees are doing well with their function. So it means now that if we will offer stock-based compensation to these employees or to our employees that is tied to the fair value of the shares or to the net income of the company, then aside from the employees having or receiving more rewards or more compensation than usual, the companies are also having more income and
Yeah.
having higher fair value of shares. Now, going back to your question, just like what I have said, tying stock-based compensation to performance metrics can align incentives with company goals and promote accountability. So more companies are actually using metrics like revenue growth, profitability, innovation, operational efficiency, digital engagement, just like what JM explained,
Yeah.
ESG performance to determine these stock-based compensation awards. However, of course, setting up these metrics can be tricky. We need to be clear, or these metrics, okay, needs to be clear, measurable, and of course match the company's strategic goals. So using objective data-driven metrics instead of those subjective judgment can help ensure fairness. It's also important to set goals that are challenging yet achievable to keep employees motivated, because we don't want, of course, to set goals that are unattainable, because instead of motivating employees, these might demotivate
Yeah.
our employees.
Got to be smart.
So
Yeah.
best practices here include clearly defining the performance metrics that we are setting and ensuring they are aligned with the company's long-term goals. This alignment help ensure that stock-based compensation programs effectively drive the desired outcomes.
All right. Finally, I want to explore the emerging trends in venture capital and startups. JM, what should we know about how startups can use unconventional SBC structures?
Yeah, first off, Will, let me say that share-based compensation programs can be actually a game changer for startups.
Really?
Yes, because we know when you're starting a business, usually cash is tight,
Mm-hmm.
and you still want to get the professionals or the talents that you definitely need in order to propel your business to where you want it to be. So offering equity or share-based compensation programs can actually be a powerful tool to attract and actually retain the talent that you need. Startups often use these equity compensation to give onto their early hires. And some startups actually create SBC programs with flexible vesting and accelerated vesting conditions to be more attractive. By saying accelerating vesting condition, it's when the company already achieved certain milestones, then the share-based compensation already vest, or the benefit will already be given to the employees. So that again motivates the employees to contribute more to accelerate the growth of the company. And another innovation the companies use is in terms of phantom stocks and stock appreciation rights. Those are forms of share-based compensation programs. These alternatives, however, give a chance to the company to still manage equity dilution. So while traditional stock-based compensation, such as stock options can be an attractive method to get employees or get the professionals you need, they dilute the ownership. But for phantom stocks and stock appreciation rights, they don't necessarily dilute your ownership. And as a founder, of course, you still want to keep as much equity as you can.
Yeah.
Because you still have to deal with investors, other stakeholders.
Yeah.
And so
There's a lot of options for startups to use as SBC programs, right? But it's basically saying to their employees that hey, I know we're small, but if you stick with us and we grow, you'll get rich.
yes,
We'll take care of
yeah,
you.
that's it.
That's the very basis. Oh, that sounds nice. That
Yeah.
sounds neat.
Yeah, and of course, looking into that direction, it's a bit difficult for startups to do that
Yeah.
because you still want to retain as much as ownership as you can. But with the help of proper professionals,
Mhm.
they can probably guide you in terms of figuring out what share-based compensation program you can establish for the particular needs of the professionals that you're getting, and also the what level of equity can you let go to
Mhm.
incentivize the people that you're trying to get assistance with in terms of building up your business. So I'll be sharing some practical tips or best practices in terms of how startups could look into that space. So first is to revisit their company goals, again, what they're willing to let go, and align that with their share-based compensation program. Second is to actually do their homework and align or benchmark against peers, say companies working in the same industry or same startup stage. So they could use the experience of the previous startups to properly develop a more suited share-based compensation program to their needs.
Mhm.
And third, as I've keep mentioning, they need to engage, or they could engage professional advisors who could cover legal, tax, and other financial expertise, particularly technical accounting and figuring out how to account for such stuff, because they can provide founders valuable guidance on designing their programs, and they could help the founder ensure that they are in compliance with, again, regulations, tax rulings, and ensure that in fact the program that they will develop will be effective for their needs. And as economies regularly and rapidly change, my fourth advice would be to regularly review and adjust their share-based compensation as the time passes. While you've established a certain share-based program for the first year, you can definitely switch it up on the next year or the next cycle of your program that you will issue to your employees. And more importantly, again, always revisit the impact of equity dilution.
What does that mean?
Meaning they have to protect their ownership while giving incentives to the employees or to the professionals that they deal with.
Yeah, as much as they want to be kind, or as much as they want to give out everything they have, they still got to think about themselves.
Yes,
right?
correct.
Right. That's a great overview, and I think with that we've covered a lot of ground today, from rethinking traditional SBC approaches to exploring new trends and challenges. As we wrap up, think about this. How might these evolving trends in stock-based compensation impact your career or business strategy? Have you revisited your SBC, related accounting, strategies, or your plans? Reflect on how these insights might affect your decisions moving forward. Thanks to both of you for your valuable insights and our listeners for tuning in. Again, I'm William, and thank you for listening. And on behalf of JM and Rain, you guys get to say your goodbyes now.
Thank you everyone for tuning in. I hope you got a lot of information and definitely worth considering for your decision making.
So thank you for listening as well. And I hope we are able to impart with you guys some invaluable insights that you can use on how you can properly formulate your stock-based compensation programs, especially for those startups.
And with that, we'll see you next time. Thanks for tuning in to The Beehive.